Today on Quickly Quantum, Quantinuum just posted its first earnings report as a public company, and the numbers tell two completely different stories depending on which line you read. A 279% revenue jump on one hand, a $597 million loss on the other. Before that, in the headlines, MIT and Lincoln Laboratory researchers figured out why some qubit errors show up in clusters instead of alone. Turns out cosmic rays and a vibrating refrigerator are both to blame. A Georgia Tech and Michigan proof mathematically shuts the door on quantum advantage for power grid math. And a new Nature paper builds one of quantum computing's most useful entangled states out of qudits instead of qubits on a photonic chip. Welcome back to Quickly Quantum, your daily brief on the quantum frontier. It's Wednesday, August 12th, 2026. Let's get into it. First up, Q-era computing and Zapata computing are teaming up, and the goal isn't a bigger qubit count. It's proof that somebody's actually willing to pay for this stuff. The Business Journals reports the partnership aims to demonstrate business value on Q-era's neutral atom hardware, the trapped atom architecture competing with Quantinuum's trapped ions and IBM's superconducting chips, with Zapata bringing the application layer on top. We haven't independently confirmed the details on this one yet, so treat it as reported rather than settled. But the timing says something. It lands the same week as Quantinuum's earnings, and together they capture where this industry's marketing has shifted. A year or two ago, the pitch was qubit counts and error rates. Now the pitch is a logo, a partner, a use case, anything that looks like revenue instead of research. That's a healthy shift in principle. The catch, and it's the same catch every time one of these announcements lands, is that a press release isn't a customer check clearing the bank. The real test is whether Q-era and Zapata can point to an actual paying customer, not just a joint slide deck. Correlated qubit errors have a rap sheet now, and MIT and Lincoln Laboratory just named two suspects. Superconducting qubits sometimes fail in clusters instead of independently, which is bad news because surface code error correction, the leading scheme for stitching noisy qubits into reliable ones, assumes errors are independent. Break that assumption, and the whole error correction math gets harder. The team found two distinct physical causes. One is cosmic rays. High-energy particles slam the chip, kick loose so-called quasi-particles that tunnel across the qubit's Josephson junctions and can knock out several qubits at once for tens of milliseconds. The other is mechanical. Vibrations from the pulse tube in the dilution refrigerator, the cooling system that keeps qubits near absolute zero, rattling the whole array on a beat the team matched directly to accelerometer data. There's a fixed path, too. Engineering a bigger superconducting energy gap across the junctions cut both error types down, and simply running the experiment in a different fridge with a different mass reduced the vibration errors further. This is a single-source report from Quantum Zeitgeist, and naming the disease isn't the same as curing it at scale. But you can't engineer around a problem until you know what's actually causing it. Grid optimization is one of quantum computing's favorite pitches, and a new proof just poured cold water on it. Researchers from Georgia Tech and the University of Michigan, Cameron Kanpour and Samuel Talkington, ran the standard grid benchmark library, PGLib, and proved that realistic grid topology mathematically kills any quantum speedup for DC power flow, the basic math of how electricity moves through transmission lines. The problem is structural. Real grids tend to split into two big regions connected by just a handful of lines, and that shape forces a measure of how hard the equations are to solve to grow quadratically as the grid expands, erasing whatever edge a quantum algorithm might offer. The obstruction doesn't stop at DC power flow either. It extends to AC power flow and unit commitment, and the team formally verified the proofs in a theorem checking language called Lean4, about as rigorous as this kind of claim gets. This is single source from Quantum Zeitgeist, and it's worth flagging specifically because it's a negative result in a field that mostly generates noise about positive ones. Grid optimization is a use case boosters love to cite. This one says, at least for this formulation, don't hold your breath. Here's one that actually made me sit up. A team has apparently solved a years-old puzzle about how to build W states, an entangled state that's more resistant to particle loss than the more famous GHZ states, which makes it valuable for quantum networking and sensing. The trick was swapping qubits for qudits, quantum units that can hold more than just 0 and 1, and building the whole thing on a photonic chip with fidelity above 90%, according to a new paper in Nature. Alan Woodward, a computer science researcher who posts as @ProfWoodward on X, wrote that researchers just solved a years-old puzzle, how to properly build W states using qudits, and actually built it on a photonic chip with fidelity above 90%, adding, We live in interesting times. This is a single X post citing that Nature paper, so we haven't independently verified every detail beyond what's in the post and the paper itself. But qudits on integrated photonics, done well, is exactly the kind of materials and engineering combination that turns a nice theory result into hardware people can actually build quantum networks with. Back on August 5th, IBM claimed a trusted quantum advantage era with 3 new papers, one built with the startup GTX Mentema. Today, that claim is getting picked apart in public. A physicist investor who posts as @QInvestorNotes on X put out a deep dive thread arguing that the choice of problem in the QDMA paper, a parameter setting balancing a readable signal against high entanglement, does a lot of the work in making the advantage claim look clean, since the teams scanned the whole parameter space first and picked the spot where classical methods struggle most. IBM's own account leaned into that trust framing on X, writing, "How do you trust a quantum result when classical verification is no longer possible?" and pointing to that same research as a framework for building that trust. Not everyone's convinced the framework proves what IBM wants it to. ETH Zurich's Dominic Hangleiter told IEEE Spectrum that the Quantinuum and algorithmic results only show something is hard to simulate, a meaningfully weaker claim than advantage. IBM's Jay Gambetta pushed back, saying the point is to produce trusted outcomes that enable open debate, not settle it outright. None of the 3 papers have finished peer review yet. This is a live argument, not a closed case. And finally, Honda Motor is putting money into Quemix, a Japanese quantum software startup, to push quantum algorithms into materials research, specifically next-generation battery materials, part of Honda's carbon neutrality push. The 2 companies have history. They jointly built a quantum state readout technique last year, and this past June, a quantum algorithm that speeds up density functional theory calculations, a workhorse method in computational materials science. No investment amount was disclosed. This fits a pattern we've seen all year: automakers and chemical companies quietly buying options on quantum materials science well before anything resembling fault-tolerant hardware exists. Quemix says the goal is to move the technology past theory and experiment into practical materials development, which is the language every quantum application startup uses, and it's only worth something once a battery actually ships. It's a hedge, not a bet that the technology works today, and useful quantum advantage in materials science is still unproven at any meaningful scale. Our main story today: what a 279% headline is actually buying Quantinuum and what it's covering up. Quantinuum, the trapped ion quantum computing company, filed its first earnings report as a public company this week, the first real chance investors have had to look under the hood since its June IPO raised $1.7 billion in gross proceeds. Here's the headline number: second quarter revenue of $8 million, up 279% from $2 million a year ago. That's the number every press release is leading with, and on its face, it's a striking jump. Now hold that next to this one, the company's GAAP net loss. That's the loss calculated under the standard accounting rules everyone uses to compare companies apples to apples. Came in at $597 million, more than 10 times wider than the $57 million loss a year earlier. Adjusted EBITDA loss, a narrower measure that strips out some non-cash items, widened to $68 million from $43 million. Quantinuum says the loss is driven mostly by non-cash equity compensation tied to the IPO. Stock-based pay that doesn't cost the company cash out the door today, but still shows up on the income statement. And the company isn't short on runway to absorb it. It's sitting on roughly $2.1 billion in cash, cash equivalents, and short-term investments. The income statement has a couple more numbers worth sitting with. GAAP gross margin was negative 64.4%, meaning the direct costs of what Quantinuum sells still exceed what it brings in, though that's an improvement of 27 percentage points from a year ago. Strip out certain non-GAAP items and adjusted gross margin comes in at 62%, down just 60 basis points year over year. On a per-share basis, the GAAP net loss works out to $1.93 a share versus an adjusted net loss of 28 cents. There's a wrinkle the 279% headline doesn't tell you, though. First half revenue was actually down 37.5% year over year, which the company attributes to contract timing. Quarterly revenue at a company this early and this small can swing hard depending on when a single deal lands. Management's full-year guidance is $28 to $32 million, with a midpoint around $30 million. On the same day, Quantinuum announced what might be the more consequential piece of news: a multi-year partnership to put its Helios trapped ion machine inside Oracle Cloud infrastructure as a managed service, running alongside OCI's own GPU and high-performance computing stack, plus a parallel collaboration with HPE aimed at hybrid quantum classical workloads, and a supply chain deal with a major electronics manufacturer. For a company at Quantinuum's stage, a cloud distribution deal like that can matter more long-term than any single quarter's revenue line, because it puts Helios in front of every enterprise customer who already buys Oracle's infrastructure, without Quantinuum having to sell them one at a time. The company also says its Nexus cloud platform for building quantum applications is now used by 180 organizations. Now, we flagged something about Quantinuum back in July. The company has a habit of incrementally re-announcing milestones, in that case around its topological qubit work with non-abelian anyons, in a way that outran the actual scaling progress underneath. That's a different corner of the business than an earnings report, but the same instinct is worth applying here. Look past the headline framing to what the underlying number actually says. So does the 279% number justify the swagger? Here's the read. @Barron's Online covered it on X about as flatly as you'd expect from a financial outlet, posting the headline, "Quantinuum posts first earnings since IPO, strikes Oracle quantum deal." No spin, no verdict, just the two facts sitting side by side, and honestly, that tells you something. When even Barron's own account won't pick a side on whether this is a win, that's a signal the story is genuinely split rather than a case of good news some killjoy is overthinking. And I think split is exactly right, because look at the pieces separately and you get two different companies. On one side, there's a business generating a real, if tiny, revenue stream with margins that aren't bad once you strip out expansion costs. Adjusted gross margin at 62% means the quantum computing access and services Quantinuum sells today actually make money on a per-dollar basis. On the other side, there's a company burning through capital at a pace that would sink almost any business that wasn't sitting on $2.1 billion in the bank. The GAAP net loss of $597 million isn't really an operating story. It's mostly a paper story, driven by equity compensation triggered by the IPO itself, a mostly one-time accounting event rather than the company torching cash on lab equipment. That distinction matters, and it's exactly the kind of distinction a 279% headline press release has zero interest in explaining to you. Then there's the first half revenue decline, down 37.5% year over year, which the company blames on contract timing. I don't doubt that's part of the truth. Quarterly revenue at an $8 million company is going to be lumpy because one big contract landing in one quarter instead of the next can swing a year-over-year comparison by dozens of percentage points. But it's also a reminder that a 279% quarterly pop measured against a $2 million base a year ago isn't the same kind of number as a mature company posting 279% growth. It's a small business having a good quarter, dressed up in the language of a breakout. That $2 trillion figure floating around the quantum computing narrative this year isn't Quantinuum's market cap or anyone's actual estimate for this specific company. It's the kind of total addressable market number the industry likes to wave around to justify sky-high valuations on companies that, today, post $8 million a quarter. An $8 million company doesn't need to single-handedly justify a $2 trillion industry thesis, but the gap between those two numbers is exactly why every quarter like this one gets read as a referendum on the whole sector, not just one balance sheet. The Oracle deal is the part I actually find more interesting than the income statement. Putting Helios inside Oracle Cloud infrastructure, next to OCI's GPU and HPC stack, means Quantinuum doesn't have to sell enterprise customers on quantum computing from scratch. It just has to be the options sitting next to infrastructure those customers already buy. Same logic applies to the HPE collaboration. That's a distribution strategy, and for an early-stage hardware company, distribution is usually a better long-term signal than any single quarter's revenue line because it lowers the cost of every future sale. So where does this land? I think the 279% headline is technically true and substantively misleading if you stop reading after the first sentence. And I think the Oracle and HPE partnerships, plus a guidance range specific enough to hold the company to, are the more useful signal about where this business actually stands. Quantinuum is early stage, well capitalized, growing off a tiny base, and burning cash mostly on paper rather than physically. None of that is damning on its own, and none of it is a $2 trillion validation either. Time for the hype check. The case against. An $8 million revenue base wrapped in a 279% headline, a first-half revenue decline explained away as timing, and a GAAP loss running roughly 75 times the size of quarterly revenue. The case for. Real margins on real revenue, a genuine Oracle Cloud distribution deal, and a guidance range transparent enough to check them against in 6 months. Weigh both, and I land this one at a 5. If the Oracle and HPE playbook works, Quantinuum's enterprise customers get quantum access bundled into infrastructure they're already buying, and the losers are hardware-only rivals, still having to sell customers on quantum computing from scratch, one contract at a time. If today's mix of hard numbers and honest skepticism is your kind of quantum coverage, follow Quickly Quantum wherever you listen, so tomorrow's episode just shows up. This has been Quickly Quantum, an AI-voiced podcast, created and built by a real human using today's cutting-edge technology. Nothing you heard on this show is financial advice. I'm Brian Lampert, and I'll catch you all tomorrow. Take care.